On this episode of Taking Stock, Eppley is selling 60 million new preference shares at $20 each. Could this be the right investment for you? We'll find out more from Managing Director Nicholas Scott.
We fund our business with our own money in ordinary shares and preference shares, and we do that in the ordinary course. And in this particular raise, we're raising $1.2 billion with the ability to upsize.
And later, the analysts weigh in on the latest market developments. Barita wants to do another APO in less than a year.
It's not as abnormal for companies to have various rounds of raising capital. For example, Proven has had various rounds of raising capital. So it's all a matter of seeing what the capital is going to be used to do.
And the Jamaican dollar has passed 155 to 1 US. Should you be worried?
It's definitely cause for concern. It's definitely, I think yesterday was 155, 36 or 37.
I'm Kalila Reynolds and welcome to Taking Stock. We're bringing you all the latest business news and telling you how it will affect you and your money. But before we get started, head over to my website, KalilaReynolds.com/newsletter to get my newsletter straight to your inbox twice a week. You can click the link up here or in the description box below. Now come on, let's get this money.
But first, here's what's hot, brought to you by Jamaica Money Market Brokers, your best interest at heart. Cygnus Group has launched an initial public offer for its real estate finance subsidiary. They're seeking to raise almost $4 billion or 25 million US through the sale of 207 million ordinary shares. The offer is upsizable by a further 38 million shares. Just over 134 million shares are reserved, with 72 million available to the public. Shares are priced at $19.30 Jamaican or about 13 cents US. Existing shareholders get a discount at $17.90 Jamaican or 12 cents US. Key investors also get a discounted price of $18.30 Jamaican or about 12 cents US. A minimum of 1,000 shares can be purchased. The offer opens on July 23 and is scheduled to close on August 20 or anytime it becomes fully subscribed. Cygnus Capital is acting as lead arranger for the offer, while Sagicor Investments and Scotia Investments are joint lead brokers. Cygnus says it intends to use the proceeds of the IPO to invest in real estate assets. More than 119,000 persons were without a job in Jamaica as at April 2021. That's 14,000 more when compared with 2019, resulting in an unemployment rate of 9%. The Statistical Institute of Jamaica Statin released the latest figures last week, noting that the comparison was made to 2 years ago as no data was collected for the same period in 2020 due to the pandemic. As expected, most jobs were lost in the arts, entertainment, recreation, and food services industries. These were heavily impacted by the pandemic. Meanwhile, Statin says there were 1.2 million persons employed as of January 2021. Over 40%, or about 498,000 persons that were employed, said they experienced either complete or partial loss of employment since March 2020. The price of goods and services rose slightly in June. According to Statin, inflation for the month was 0.7%. Statin says the slight increase was impacted by an almost 2% movement in the heavily weighted division food and non-alcoholic beverages. This was due mainly to higher prices for some agricultural produce, cereal, and meat. Also contributing to the overall inflation increase was an almost 6% increase in the restaurants and accommodation services division due to higher prices at restaurants and cafes. There was also a 0.5% increase in the transport division due to higher gas prices. In the meantime, the rise was tempered by lower electricity, water, and sewage rates. The 12-month inflation rate up to June now stands at 4.3% within the Bank of Jamaica's target range. The Jamaican dollar has been rapidly depreciating in recent days, falling to new record lows last week. It's unclear what has been putting the dollar under pressure. However, the situation has forced many online shoppers in particular to either cancel or postpone orders. Last Wednesday, the dollar edged past the 155 to 1 US dollar mark and remained above the threshold at the close of trading last week. The Jamaican dollar opened trading against its US counterpart on Monday at $155 flat to 1 US. Meanwhile, the Bank of Jamaica BOJ remains silent on the situation. In previous instances of volatility, the bank intervened by selling US dollars to authorized dealers and cambiers. Since the start of the year, the Jamaican dollar has been trading over $140 to 1 US with the previous record low of $154.82 occurring on April 27. Caribbean Producers Jamaica has graduated from the junior market to the main market of the Jamaica Stock Exchange. The transition happened on July 13, mere days from the company's 10-year anniversary as a listed company. It got approval on July 9. Companies listed on the junior market are afforded a 10-year tax break. CPJ's transition opens opportunities for the company to source new equity capital through a rights issue or additional public offering APO. Based on JSE rules, junior market companies cannot have an issued share capital larger than $500 million unless they get permission to remain while paying listing fees as if they were a main market company. The dream is on. Dream Entertainment has confirmed that the government has approved Dream Weekend. The 5-day party series will run from August 5 to 9 in Negril. CEO Scott Dunn told Khalida Reynolds on Taking Stock recently that the team was confident of a yes based on their proposal for staging the flagship event and its economic value. It's understood they're now awaiting word from the government on what specific protocols they will be required to implement. Last year's staging of Dream Weekend was cancelled due to the pandemic. What's Hot was brought to you by Jamaica Money Market Brokers, your best interest at heart.
And when we come back, should you buy into Eppley's new preference share offer? Hey moneymakers, you're not an official part of the family until you have your merch. Visit KalilaReynolds.com/store to order your t-shirt and your mask today. Let's get this money. This segment of Taking Stock is brought to you by Bulwark Insurance Agency. Insurance made easy. Welcome back to Taking Stock. Eppley is seeking to raise $1.2 billion to refinance its debt. To do this, it's selling 60 million new preference shares broken down as follows. 15 million Class A preference shares with a 5% rate due in 2023. 25 million Class B preference shares with a 7.25% rate due in 2026, and 20 million Class C preference shares with a 7.75% rate due in 2028. The shares are selling for $20 each, and you have to buy at least 200 shares or 4,000 Jamaican dollars worth in order to participate in this offer. The lead broker is Sagicor Investments, and if you want to know more about how preference shares work, check out the last episode of Money Mondays JA. You can click the link up here or in the description box below. Well, joining us now to discuss, we have Managing Director of Eppley, Nicholas Scott. Hi, Nicholas. How are you?
I'm great, Kalila. Thanks for having me. I look forward to this discussion.
It is so good to have you on because a lot of people might not realize this. You didn't even realize this. You were my very first interview since we started doing this whole thing, even before Taking Stock. We were at Hype TV Studios at the time, and you were releasing Eppley Caribbean Cooperative Fund Value Fund.
That's right. That's right. And as I said to you, we didn't even know that at the time, but we're happy to be the first, and we're really grateful to be talking to you again about this new development.
Yeah, so that interview is what actually gave me the inspiration to start Taking Stock. So I'm really happy to have you again, this time to talk about the preference shares that Eppley is offering to the market. But before we go into the actual share offer, just give us a little background about Eppley, the business. What do you guys do? How do you make money?
Thank you for that question. So Eppley Limited it's an investment company. It was started in 1973, actually, but it was rebranded and repositioned 7 years ago when we took the company public, then on the junior market, and it's now on the main market. And Kalila, it's been quite a journey. During that time, we've increased our profits at a compounded rate of 40% on average for the last 7 years. And today, what Eppley is it's an investment company that makes money in two ways. We have our own money that our shareholders have invested, both our ordinary and preference shareholders. And we invest those in three things. We invest those in credit, which is loaning and leasing money to people. We invest that in real estate, and we invest that in infrastructure. And increasingly, we not only do that for ourselves, earning money for our investors, but we do that in funds that we administer or manage. In one case with NCB, we're very privileged to be NCB's a partner in the mezzanine fund. and also in the property fund, which is a publicly listed a mutual fund that we manage. And so Eppley Limited today makes money in two ways: investing its own capital and investing money on behalf of investors in funds that we manage.
So I'm familiar with Eppley on a personal level through your insurance premium financing product,
Great.
which allows people to, so you don't have to pay the upfront cost for the full year of insurance. You can pay in installments through Eppley, which is a very useful product. And I noticed that it's a good chunk of business for you.
Absolutely, and that's the history of the business. I mean, but that's how the business started. And even though today it's not a big part of our business and an important one, but let me use that to sort of make this point. We believe we're very principle sort of driven in our investing. We're fairly conservative. And we believe that the right way to make money over time is to take advantage of areas where there's a high reward, with limited risk. And insurance premium financing is where we started, but we've kept that same principle, Kalila, as we've moved into larger corporate loans, fleet leases, buying real estate, and owning infrastructure. So it all started there, and that's a great example of the principles behind the business.
Absolutely. And you've been doing quite well, as you said, 40% compounded growth over 8 years. But 2020 was a particularly good year for Eppley. You all grew net profit by 38% in a pandemic. How did you do that, Nicholas?
Well, we're very proud of that, and thank you for raising it. But I'll say this: we have a culture that's very contrarian, and I think there are going to be periods of time, Kalila, going forward, and in the past, where in frothy markets where things are very buoyant, we could underperform some people who perhaps are not as conservative as we are. But in periods of tough markets, that's really what we've built this business for. We have a portfolio that's very carefully underwritten, that's very thoughtfully put together. And so in that context, it's not surprising that in a choppy market, that's really when we shine. And that's really good for our investors because it allows them to diversify and own an asset that may be there for them when the other ones aren't.
You use the word contrarian, and that simply means going against the grain, right?
Sure. Yeah. I mean, when we started investing in credit, for example, back in 2013, when we took the business public, you have to remember, I mean, this is back in a different time when most of the financial institutions were just lending the money to the government, and most people were only buying repurchase agreements and repos. And we pioneered credit investing. We then pioneered mezzanine investing regionally. We've started a property fund. And so, we take an attitude that's independent in our thinking, as principle driven, and it's obviously served us well, and it's ingrained in our culture.
All right, so let's come to the current offer. You are looking to sell 60 million preference shares, various classes, and raise $1.2 billion. Why come to the market again? Because you did preference shares in 2018, so just less than 3 years ago, and now you're back. That's really been how we've funded our proprietary portfolio, even going back long before that, even to 2013 or 2014. So we fund our business with our own money in ordinary shares and preference shares, and we do that in the ordinary course. And in this particular raise, we're raising $1.2 billion with the ability to upsize and using that to refinance existing preference shares just to take advantage of the favorable interest rate environment. And we've been hearing from investors that they would like to participate and continue to participate in Eppley. And we've chosen to do this raise at this time to continue to fund our business and to refinance some of the existing prefs. You do have some preference shares that are due to retire soon, so why not just extend the tenure of those?
Well, we have the cash to pay them off, but we want to continue to grow our business, and it's a favorable environment at the time. And we're very fortunate that we've had a good group of preference shareholders, like I said, for many years now, that they're become accustomed to enjoying regular, steady income. I pride myself on keeping in touch with our investors, and many of them it's an important stream of income for them, and we're just delighted to continue to be able to generate returns and share some of that with our investors.
And why JMD as opposed to USD? Because you just retired a US dollar note. You could have used it for that.
That's a good question. I think, when we look at what we think we want to do with the money and where we see good investment opportunities. Many of them are in Jamaica, many of them are in Jamaican dollars, and then we try to match prudently one with the other. And then we also just look at the differential in rates and what's in the best interest of our shareholders, and that's where we've come down. But in the past, we've had US dollar issues as well.
You mentioned that your preference shareholders have come to expect that reliable stream of income. So we have various categories of viewers for this program. Some are new investors, some are very savvy, been investing for a long time. Can you just explain for us how preference shares are different from ordinary shares?
Absolutely. So ordinary shares are the shares that are most common, certainly in Jamaica, where you have an undivided ownership interest in a company and you benefit from capital appreciation on the market, and you also get dividends. And those dividends are not contractually due to be paid. They're at the discretion of the board. Preference shares, as the term suggests, are preferred in the sense that in a downside, they have a more senior claim on the firm, so they're less risky in that regard. And they also have the benefit of providing contractual guaranteed income on a regular basis. And so they're particularly good for people who are looking to supplement their income. And certainly at a time like this, as you would know, Khalila, with low interest rates globally, it's a very attractive thing to have in one's portfolio to be able to rely on a steady stream of regular dividends.
Dividends is a magic word for our viewers. They love to hear dividends. What's the general dividend policy of Eppley?
Well, on the preference shares, there are three classes, and the first class, which is a 2-year, will pay a 5% dividend. The 5-year will pay a 7.25, and the 7-year will pay a 7.75, which compares very favorably to other recent issuances in the market. On our ordinary shares, we pay the vast majority of our earnings through in dividends, but of course that's ultimately a function of our profitability and the discretion of our board. Our preference share income is contractual and guaranteed.
Basically, investors are rewarded for the longer they allow you to keep their money. So if they lend you their money for, what was the first one? 5 years, the class A?
The first one's 2 years.
2 years, then you get 5%. And if
Correct.
they lend you their money up until 2026, they get 7.25%. And if you lend your money until 2028, they get 7.75%, which is a pretty decent rate of return. And we should also explain that at the end of the tenure, you get back your full investment.
You sure do. And yeah, that's the in finance, we call it the term structure of interest rates, but the general principle that the longer you part with your money, the more you should be rewarded. And with our arranger Sagicor, we've priced this offer, as you said, to be very compelling relative to savings rates, relative to corporate rates, and then relative even to more recent preference shares. So we're happy to give a little something back to our existing and potentially new preference shareholders.
So it's kind of a hybrid between a shareholder and a bondholder, because you get back your full investment at the end, and you still get to collect dividends in the interim.
That's right. And I would add one more important point, which is that they're listed. So if you don't want to wait until the end to get your money back, you can always sell your shares, which isn't true with some fixed income investments. It is certainly true with others. So you do have that liquidity should you need it, and should the need arise. And that's an important thing to consider for anyone listening to this as well.
All right. So a few months ago, the finance minister accused many people coming to the market of offering candy and selling offers like lollipops, and highlighted that we need to be more aware of the risks involved. So tell me about some of the risks that may be involved in an offer like this.
First of all, we as a company, we fully support the notion that as market participants, we should have a higher bar in terms of information that we provide to investors, and certainly want to be ahead of that. And I would completely agree that all investments involve risk, despite our really strong track record. That's always inherent, and of course you can have volatility in the performance of the shares. You can have obviously issues in the underlying portfolio, but I would just encourage investors to look at the prospectus, which all the risks they are contained there, and look at Eppley's historical financial performance and its portfolio, and weigh the fact that the preference shares are the most senior claim on the business, that all of the ordinary shares would have to be impaired before there was any challenge with them getting their money, and make their own decisions. But I would encourage investors to weigh not only the rewards but the risks as well.
Tell me about Eppley's plans for the coming year and years. What do you have in the pipeline? What are some of the things you're looking at?
We're so excited. I mean, this is a time that we just made for our business. If you ask me what a challenging time was, it probably was, right before COVID emerged, when there was a sense that like risk didn't exist anymore. And it was harder for us to find compelling investment opportunities. And we have one of the strongest opportunity pipelines that we've ever seen. We have ample capital on our proprietary portfolio and in our funds. And I think you're going to see us continuing to deploy capital in the themes that we invest in, which is credit, mezzanine, and real estate. But you'll also see us branching out into new areas like infrastructure, which we have an important infrastructure investment on our books today, and we're assessing a few more, and that's going to be a big opportunity for us going forward.
Are you going to keep that same ratio of investments, more or less? I see where you have the biggest chunk of your income coming from loans, followed by cash and bonds, then leases. So are you going to keep that, or is there any rebalancing in the works?
I think I wouldn't want to put too fine a point on it, but I would say, you're going to see asset management income and income from fees that we make managing money for others or providing administrative services alongside partners like NCB and others. That segment of our business, you're going to see that continuing to grow. That's very high quality earnings. And then you're probably going to see a shift more towards Jamaica. We're seeing some of the best opportunities regionally right here at home. And then, as I mentioned, we're going to complement credit and real estate with infrastructure. And I think that's going to be a big opportunity for us going forward.
What are your projections for the real estate market right now? It's one that everybody's heavily watching.
Well, if you're talking about Jamaica and residential, which is what most people talk about, that's not an area that we're a big investor in, as you know, but it's certainly been interesting to watch. I guess what I would say, just as a general comment, is there's a reason that for thousands of years across many different cultures, people have chosen to preserve their wealth in real estate, notwithstanding the most intense uncertainty. It's been remarkable to watch how resilient real estate assets around the world, and in the Caribbean, no different, and Jamaica in particular, have been, notwithstanding all the shocks of COVID. In terms of how things are going to develop going forward, it depends on which sub-asset class you're talking about. We're particularly excited about industrial. We've made some big investments there. And I think you'll continue to see us looking for good opportunities in that space.
Industrial. Okay. But I know you also are heavily invested in commercial real estate.
Yeah. So within commercial, the big categories are office, and we do own office through our property fund. And then there's retail, and we have some important retail assets. Again, this is in the property fund that Eppley manages. But when I say industrial, I mean warehouse and distribution centers that are in the bucket of commercial real estate, but are a very, we think, attractive subtype because they're not as glamorous. It's not an area that a lot of people are looking at. and it's remarkably resilient from a cash flow perspective. And so we like that very much.
And that tells me that you're expecting economic activity in that sector to pick up.
Well, it's not waned. I think if you look at the real distribution and manufacturing segment of the Jamaican economy throughout COVID, if you look at the big names in that space that are publicly listed, who occupy those types of assets, who occupy the cold storage assets that we own, the warehouse that we own, the distribution chain. If anything, this has just underscored how critical those pieces of the supply chain are. And they really haven't skipped a beat, not to mention if things recover. So we really like that sub-asset class. We have some important assets there in our property fund, and we're gonna look to find new opportunities in that space.
Well, thank you so much, Nicholas, for joining me. Really appreciate it, and all the best with the offer when it's open now. So all the best.
It's open, and I should say that if anyone is interested, Sagicor is our arranger. They have a e-invest platform, and JMMB has also agreed to act as a selling agent using their Moneyline platform. And I would encourage interested investors to consult their brokers, of course, but to also go to those resources if they're interested. So thank you.
Thanks again, Nicholas.
Thank you for having me.
So now that you know more about the offer, what do you think? Does this seem like a good investment, and will you be buying? Comment below and also take our poll. The link is in the description below. Up next, we've got your market recap, and the analysts are standing by. This segment of Taking Stock was brought to you by Bulwark Insurance Agency. Insurance made easy.
Time now for your market recap, brought to you by Sagicor Investments. Think wealth, think Sagicor Investments. The Jamaica Stock Exchange declined, with the combined index losing more than 1%. 106 stocks traded across both the main and junior markets of the JSE for the week ending Friday, July 16, 2021. 41 advanced, 58 declined, and 7 stayed the same. Nearly 173 million shares changed hands on the Jamaican dollar market, totaling a whopping $14 billion. That's because $13.8 billion worth of NCB shares traded on Monday alone. It was the largest traded volume of NCB Financial Group shares in over 2 years on the Jamaican stock market. According to the Financial Galena, this coincided with the President and CEO Patrick Hilton and the Chief Financial Officer and Deputy CEO Dennis Cohen both surrendering shares as part of a change to their compensation arrangements. Not surprisingly, NCB Financial Group traded the most, taking up 55% of the market. The stock lost $2.92 to open this week at $139.83. Fesco traded the second highest, with people buying and selling 17 million shares in the company. The stock gained 18 cents to open the week at $1.62. And Wigton Wind Farm ordinary shares rounded out the most traded, taking up nearly 8% of market volume. The stock lost 3 cents to open the week at 56 cents. Now let's see who had the biggest gains. Sterling Investments USD stock price rose nearly 22% to close last week at 2 cents US. Knutsford Express Services stock price rose nearly 19% to be second for this week's biggest gains. The stock opens this week at $8.41. Rounding out our biggest gains, ISP Finance Services, which gained $3.50 to open this week at $25. On the losing side now, MPC Caribbean Clean Energy was the biggest loser for the week, down nearly 19%. The stock closed last week at $119.49. JMMB Group 7.15% cumulative redeemable preference shares was second on the list. Its stock price down 17% this week. The stock opens this new week at $2.77. Rounding off the biggest losers, CAC 2000, which lost 15% to close last week at $9.50. Market recap was brought to you by Sagicor Investments. Think wealth, think Sagicor Investments. This segment of Taking Stock, The Analysts, is brought to you by Proven Wealth and Ideal Portfolio Services.
Welcome back to Taking Stock. I've got a team of analysts to examine the week in business. I'm joined by Wealth Advisor at Ideal Portfolio Services, Dwayne Taylor. And we also have back with us Assistant Manager of Private Equity at Proven Management, Julian Morrison. Julian and Dwayne, welcome back to the show.
Hey, Kalila.
Julian is back in his bookish setting. You're working from home again?
Yeah, that's right. I have to lead
back
by
in the
example.
library. Is it all investment books behind you?
No, definitely not. Some of them are some titles about Christianity and the world and things like that.
Oh,
So,
wow.
yeah.
Okay. A well-read man is always good, you know.
Okay, yeah, I'll work with that.
Just saying. All
Okay,
right, so we have a few things to talk about this week. I just concluded the interview with Nicholas Scott from Eppley, and our
right.
followers have been asking us about this preference share offer, which is currently open. Just tell me briefly what your thoughts are, Julian, and then Dwayne, you can tell me as well.
Okay, firstly, a preference share is not like the stocks that we talk about most times. Normally, we talk about common stocks or common shares. Preference shares, they function like bonds, meaning that they pay periodic interest. Normally, it's a fixed amount of interest to the holders of that instrument, and it's primarily for income purposes. So typically, we do not see a large increase in the price of that instrument over the life of it, because most of the people who buy it hold it throughout the life of that instrument. What do I mean by life of the instrument? It normally has a maturity date, just like bonds. So if we look at the name of a preference share, it will be called XYZ 5% 2024. It means that it pays 5% annual interest and it matures in 2024. So that's typically the code for instruments like that, bonds and preference shares specifically.
Dwayne, do people typically go for preference shares in the Jamaican market? Do you think it's widely understood?
Well, in terms of it being understood, I do think that there's still a lot of investors out there that might not understand the concept, because we have stocks. They hear stock in it, so they might get it mixed up and think, oh, it's going to operate the same way as a common stock. But there definitely is a need for it. It offers diversity in the sense of it offering a fixed income option. Most persons, would try to go for bonds, but unfortunately, bond prices can be pretty high when you're seeking to purchase it. So preference shares offer a cheaper alternative, giving you something that, as Julian said, it's consistent interest over a period of time. And yeah, there are a lot of persons that are interested in them. Separate and apart from the institutions that would buy up, there are individuals that want that type of diversity in their portfolio, something that's bearing income for them.
It's kind of like the best of both worlds, isn't it? So you get the flexibility of owning shares in a company. So if you don't want to hold it until the maturity date, you can always sell it. You also get the consistent dividend payments, and then you get your money back at the end of the term of the investment too. So I think there are very many benefits to adding preference shares to your portfolio.
Yeah.
Also, too, Kalila, in terms of what is called the capital structure, there's something called seniority. So what it means is that in the event of liquidation, or if the company fails, there is a sort of ranking or priority of who gets compensated first. So first, it is the bondholders, or the people who will lend money to the company. They get paid first. Then it is followed by preference shareholders. They get paid second. Then thirdly, it is the common shareholders. So when we buy stocks, we're actually last in line in terms of seniority in the capital structure. And that is why we say, theoretically, that bonds are less risky than stocks, because bondholders are paid first if a company liquidates compared to a stockholder. So preference shares sit in the middle.
Yeah.
So by that reasoning, are preference shares less risky than ordinary shares?
From the standpoint of liquidation, yes. The other benefit too, as Dwayne highlighted, bond yields are very low. Right now, if you were to take on an instrument that matures in 5 years, you would be looking at a yield of 2%, 3%. Right now, if you were to buy one of the preference shares, you'd be getting a far higher yield, because
these ones are 5% and 7%.
Yeah.
Right. And you're paying for it at par, meaning that is the original issue price. That's what we call par. And when we buy instruments at par, it means that we're getting the yield that's the same as the interest payment or the coupon. Because when prices go higher, yields come down. So because you're buying it at issue price, you're preserving the yield that you can get. But when you're to buy a bond that's already listed on the market, you might have to pay extra, which reduces the yield that you would get on your money.
And the other thing that Dwayne mentioned, it tends to be pretty pricey to buy into a bond. So usually minimum is probably like at least 100,000, usually 500,000, $1 million.
Yeah, for sure.
Each, yeah, you have to have tall money to buy bonds for the
Yeah,
most part.
right.
So for preference
Right.
shares, at least you can, the minimum for this investment is 4,000 Jamaican dollars, which is,
Yeah.
you know,
And there are
very
pensioners who
reasonable.
buy preference shares. They live off the interest. I've seen it myself.
All right. So speaking of raising money, another company that we're all very familiar with, maybe raising some more money again soon. Barita, the hungry lion, as David Rose described them last year. They did an APO last year. They raised $13.5 billion. And here they are again, possibly, and I think probably likely, because they're taking it to shareholders on the 3rd of August to approve, possibly coming to the market with another APO. And I was reading that article in the paper. I think it's looking to be around the $10 billion range again. So what do you guys think about Barita looking to raise more money?
Okay, I'll go first.
Sure.
So we have to look at it in context. Barita has a young management team. It's not necessarily a young company, it's actually the first investment bank that is still in existence in Jamaica. However, within the context of its competitors, it is one of the smaller outfits. So you're dealing with a smaller outfit with a young management team in an industry that's still in its infancy, because our financial services space is not as advanced as in the United States or United Kingdom, for example. So when those three things are considered, it means that it's not as abnormal for companies to have various rounds of raising capital. For example, Proven has had various rounds of raising capital. So it's all a matter of seeing what the capital is going to be used to do, what type of project it's going to be allocated towards. Is it a new branch? Is it to another acquisition? Is it going to be the expansion of products and services? Is it a play to go deeper into technology? It all depends. So there's a lot to consider.
Dwayne, what do you think about Barita's hungry appetite?
It's with good intention, and we have to look at the fact that Barita is aggressively approaching the market. They're really looking to take a bit of that capital share from some of the other bigger players. And because of their stature in the industry, they're not a conglomerate. They don't have insurance or a commercial bank to back them per se. They do have their merchant bank, but there's still restrictions in terms of what they can offer from that outlet. So the only other option would be to raise capital to see any form of expansion. And we've seen so far they have grown significantly. They've onboarded a lot of professionals, into the company, and as such, this move makes sense. I think the market
They've been very aggressively recruiting, haven't they?
they have been, and they really do aim for some of the more not just seasoned but brilliant minds in the industry, to add value to the company. So them making this move, it might seem that it's coming very fast based off of what we've experienced over the past 2 years with them, but it just makes sense. They're capitalizing on the traction that they've gained thus far. So yeah, it's definitely a smart move, and I don't think they'll have any issue filling that position either.
Yeah, you never know. They might come after you guys. Meaning
Be
attracting
careful.
talent. Remember, they took Simon Johnson used to be an analyst on the show for
And
JMMB. He's now
yeah,
at Barita.
Yes,
So
that's true.
yeah,
That's
that's
true.
they
true.
tend to
That's true.
snap up the
That's
talent
very
they
true.
need. I see
That's
that
very true.
they've also opened their location in, is it Fairview in Montego Bay?
That's
As they
right.
said that they
That's
would
right.
do. That was part of the proceeds for the APO. So they're
That's right.
expanding.
Right.
They are expanding.
Yeah. All right, so let's look at some results. Lumber Depot's results are out, and I want to know what are the highlights from that, Julian?
So Lumber's results, they did very well in summary, but we have to put some things into context. So for this exercise, I will start with sales. So on the face of it, the sales are up significantly. But the fact is, we're comparing a 12-month result to a 9-month result. So for context, Lumber Depot, they sell lumber, steel, ply, cement blocks, tiles, water tank, doors, roofing supplies, gravel. So it's really a hardware store that has a variety of services. So it's really an ecosystem for building and construction. So what we've seen is that within the context of them doing so well in terms of sales, which is a 55.11% increase to 1.43 billion year over year, that has to be contextualized by what is going on in terms of construction in Jamaica on a broader scale. Now, when we actually annualize the result, we'd be comparing it to an annualized result last year of 1.23 billion. That's not on the income. That's not on the income statement. But when we annualize, what we're doing is actually growing it by a third, because a 9-month result is 3/4 out of 4. So what we're doing is growing it by a third, so that we can have an estimate of what it would look like for a full year. So we're comparing 12 months to 12 months. And when we analyze it, we're seeing 1.43 billion, which is on the income statement for 2021, compared to 1.23 billion for 2020. That's the annualized viewpoint. And from that viewpoint, we're seeing an increase of 16.34%, which is still great, especially given the challenges in the economy. Now, when we're looking at earnings stood at 145 million compared to 22.18 million. And that's showing an increase of 6.5 times in terms of the multiple, the growth, and that's huge. But when we annualize it, we're actually comparing it to 145 million compared to 29.6 million, which is still great. Now, that increase would be roughly 5 times or 4.9 times. Now, when we remove the finance income and the FX gains, because that was huge, we have to back that out, because they're not in the business of generating interest or FX gains. It's not like a Barita or an investment bank. They are a hardware store. So we have to normalize the result by backing out what is called non-core items. And that's what we call a non-core item. We back that out just for some perspective. And by doing that, we would have a pre-tax result of 131.96 million compared to 30 million. So that is still significant, right? And pretty much when we annualize it, instead of the 30.1 million, we'd be comparing it to 40 million, which is still more than 3.3 times in terms of the increase. So anyway, spin it, they've done exceptional.
That's a very big increase. What accounts for that?
A lot of it has to do with core sales. They've done exceptionally well in terms of their core sales. Even in the middle, though, what we notice is that some of their working capital items, last year, they saw a write-down. And this year, that write-down didn't occur. So that changed. The comparison between a negative number and the comparison between a positive number, it saw a major change. So some of their line items were negative last year in terms of their working capital, and now it's positive. So when we say working capital, we're talking about receivables, we're talking about inventory, things like that. So it seems as if some of their items had bad trade credit. So let's say, for example, Kalilo, you lend your mother money, right? Everybody had to lend their mother money at some point, I'm sure, especially in the Caribbean. And you go to her and say, boy, mommy, you borrowed the $500 from me. What's going on? And she look on you and tell you, boy, I carry you for 9 months ago. Come talk to me about that. That is what you call a bad credit. You have to write that down, because you say, boy, I'm not get back that $500 then.
You're not getting that back.
So those are some of the things.
Go back into the room.
Right. So given that we're in the pandemic, that could be a part of what caused that movement to change the way it did. But they're still in great condition, because when we look at operating cash flows, they had a major improvement. So last year, the operating cash flows was negative 57 million, but this year is positive 185 million.67. So what that means is that the company, in terms of the operations, used 56.83 million in terms of cash, but this year it generated 185 million in cash. So that's a significant change. The working capital attributed to this, meaning that they've been managing their inventory very well, and that's a sign of very able management. So when you're seeing sales going up significantly and an improvement in working capital at the same time, it's definitely a good sign for the company. Now, in terms of the stock itself, it's at $3.54 the last time I checked it. So that's down 4.3% from the 52-week high. However, it's up 62.4% from the 200-day moving average. So it has been running up significantly over the last 200 days. However, it still could have more room to run in terms of the improvement of the profitability, the fact that the outlook on the company will change now because of this knockout earnings result, and the fact that it's slightly lower than the 52-week high. So it could set a new 52-week high going forward, and the stock definitely has room to run. The PE is about 16.86 times. So there's definitely space for this company to have more upside in terms of the stock. And of course, the earnings itself, because the conditions support further growth based on what's going on in construction in Jamaica right now.
But how liquid is lumber? So how easy it is to buy lumber depot stocks? And I know it's just a fairly small thing there on the market.
Or in terms of the float, well,
Right.
it has its own following. It has its own following. There are some stocks that have a fan base, and for example, Jam Teas, it has its own fan base. I think lumber is growing its fan base a bit as people become more familiarized with it. They're hearing about lumber more, and especially with this kind of result, it definitely will generate a larger audience. So we could see more activity around the stock in terms of buying and selling in the next couple of months. So we could see some more activity around it. I expect it to run up because of the things that were mentioned before. This is not a recommendation, though. We're just talking about the stock.
Yes, consult your licensed financial advisor.
Consult your licensed
That's right. That's
advisor.
right.
Book a session with your proven or at Ideal. So
Yes.
before you go, guys, the dollar has now passed 155. I don't even know what to say because it passed 130 and then 135 and then 140, 145, 150. It's like, oh, and it kind of settled at 150 for quite a while during these past several COVID months. But now we're beginning to see an escalation again. Is this a worrying sign, you think, Dwayne?
It's definitely cause for concern. It's definitely, I mean, I think yesterday was what 155, 36 or 37. It's hard to approach the situation because if it is, we say, all right, fine, let's approach the market by buying up some USD and maintaining some foreign currency holdings. That's still going to drive up the Jamaican dollar further, and we don't want our local players to have an even more difficult time participating in the international market with the dollar continuing to depreciate. So it's definitely a cause for concern, especially for our local businesses that have to purchase things on the international market. We're not a huge manufacturer of certain items that companies might need, so it's a cause for concern. And even the transactions that we do, we were mentioning Barita earlier, and them raising the capital, right? That is another issue for them when they're negotiating deals with international companies, because when you do the conversion, 100 million JMD, as Julian had mentioned off air, is really nothing. It's really nothing when you convert it over to USD. So when it comes on to the transaction side, when it comes on to cost of living as well, because we can only imagine that with the dollar further depreciating, it's going to have an impact on inflation. The regular market basket is going to increase in value. And even for our gas prices, skyrocketed as well. It's just been consistently growing over, I think year to date, we can safely say the gas prices have increased exponentially. So it's a cause for concern amongst us, but the most we can do is hope that there will be some sense of recovery in the foreseeable future. But right now, it definitely is a major concern.
I've been consciously buying more local products recently because of this. Like, I didn't know that Lasco made Pampers. I have two small kids, and Pampers is a big deal in my house. I didn't know Lasco made Jack and Jill brand Pampers and wipes. So that's not a paid ad, by the way, but they're actually pretty decent. So saving some money there by buying local. But Julian, do you share the concerns about the increase in the price of the dollar, the depreciation recently. Hopefully it's depreciation and it comes back down and not devaluation, which is permanent.
So I share a lot of the concerns that Dwayne has or articulated, but it's a matter of context. So when we look at volatility in terms of how fast the dollar moves up and down, from a historical perspective, it has not been as bad as 7 years ago, for example. However, it doesn't nullify the issue. When you look at purchasing power and the fact that wage growth in Jamaica is flat or negative, it's not good, because most Jamaicans, they have to rely on their wages for survival. They don't rely on assets that throw off passive income. So really and truly, we have to think of creative ways and lucrative ways, let me say that on air, lucrative ways of trying to earn income in US dollars. Our companies should be trying to do it. Our citizens should be trying to do it, those who can. Because the fact is, as a country, we are not earning enough US dollars. So we are a service economy. We rely heavily on tourism, as we know, heard it 1,000 times already. But the fact is, we have to find a way to get foreigners to be enticed to buy our goods and services so that we can earn more US dollars. That will help to abate some of the pressures on the exchange rate. Because the fact is, we pay a lot in energy. The energy bill is a major factor. We pay a lot in food as well. We import a lot of food. Food bill is huge. And those two factors help to influence the exchange rate. And the fact is, we have to find a way. Because for perspective, on average, for every dollar we earn in exports, we spend $4 on imports. So that's a huge gap. Right, that's called a current account deficit. That current account deficit is huge. So the wider the deficit gets, is the faster the exchange rate is likely to run, all else considered. So we need to try and narrow that gap.
Usually at least some of it is made up by the tourism dollar, but you know where
There's that
the
too. Yeah,
tourism is right
definitely,
now.
definitely.
Not
But
great.
we're just nowhere near where we should be, and it's up to us as citizens to be entrepreneurial and to find legitimate means. We know that there are challenges. There are barriers around export. There are very high barriers to entry in some markets, but it's not impossible. And with the onset of technology, people can earn US dollars from their YouTube channels. This is a plug for Kalila, of course, and many others. There are ways to do it. So we have to
Yeah,
be creative.
I recently opened up a US dollar account for the same reason, because we do have US dollar streams of income, but then it goes to my Jamaican accounts and it gets converted and you lose the benefit. So
There we go.
yeah.
Yeah.
So there are reasons to do that. Although I usually advocate against saving in US, but if you're earning US dollars, then you should have a US dollar account.
For sure. And we all should try to earn some US legitimately, because as a country, that's where we need to go. We're just not earning enough US. That's all it is.
Absolutely.
I think to rally on that, Julian, you mentioned something very important about us seeking ways to earn in USD. I think with Amazon giving that green light to Jamaica in terms of, people being sellers to the international market, a lot of entrepreneurs really have to capitalize on that. List your items, market yourself, and try to build a base where persons are interested in your product. And that might be because it's not going to be the all in all that will fix everything, but it will be one of those measures that can help us, mitigate all of this, in terms of earning more USD in Jamaica. So, yeah.
Oh, one last plug, Kalila. A lot of people don't know this. So where a product is made actually makes a difference. So when we buy Jamaican products, it means that US that was spent on that product is actually going back to a Jamaican firm, which is being used to pay wages to Jamaicans, it's used to pay taxes to the Jamaican government, etc. So there's a multiplier effect in Jamaica. But if we buy that same product and it says made in Trinidad and Tobago, that multiplier effect is happening in Trinidad.
Yeah.
So when we look at the label to see where something is made, it makes a huge difference. So all the people in the diaspora, if you care about Jamaica, buy Jamaican products. Look at the label, because that is how you create a multiplier effect. It's going to come from the private sector. The government can only do so much. Countries are built on companies in terms of the economy. It's coming from the private sector.
Yeah. Absolutely. Thanks again, guys. Great discussion.
All right, Kalila, thanks.
Thanks, Kalila.
This segment of Taking Stock, The Analysts, was brought to you by Proven Wealth and Ideal Portfolio Services.
That's our show for this week. Thanks for watching. Make sure you like this video, it helps. Subscribe to this channel and share with a friend. Also subscribe to our newsletter at KalilaReynolds.com/newsletter and turn on those post notifications so that you can be the first to see all of my other features. We want to help people learn more about money so that we can all get this money together. So this week on Money Mondays JA, we've read the Eppley prospectus and we have a breakdown of the offer, including financial highlights and more. On Money Moves JA, it's our 100th episode. If you've ever been confused by financial statements, well, this one is for you. General Manager of Exim Bank's Finance Division will explain balance sheets. Follow me on Instagram and Twitter at Kalila Ray and follow at Taking Stock JA on Instagram. If you want to connect with the analysts this week, check the description box below for their contact information. Also, visit our website, KalilaReynolds.com, for financial information you can use however you like it. Watch, listen, or read. Now, tell a friend about taking stock. Investing is the new sexy, so let's make it cool to talk about money. I'm Kalila Reynolds. Let's get this money.
Let's get this money.